investor, politician, or central banker knows what's coming next, and whether inflation, stagflation, or deflation will result from the combination of interest rate rises, quantitative tightening, pay increases, record debts, and the cost of living crisis. Going all in on one scenario is probably not going to be the best of ideas, and portfolio construction will need to address a range of possible outcomes, as frankly, anything's possible, especially given the likelihood of ongoing central bank and government action in one direction or another. But carefully following the major investment themes, or 5 major investment themes, may help investors sense which way the wind's blowing, so they can try and obtain the best possible risk-adjusted returns for their portfolios, especially once they take into account the all-important issues of valuation and indeed inflation. The first key trend to watch is the yield curve. Central banks and policymakers are trying to manage inflation on one hand, but do so without tipping heavily indebted economies into recession on the other. Given that central banks made a mess of it with their recall that inflation would be transitory, it would be logical to apply a bit of a dollop of salt to their claim that they can engineer a soft landing for the economy as they rein in inflation. Economists and investors will all be looking to macroeconomic data, such as inflation, unemployment, job vacancies, wage growth, and GDP, to judge whether central bankers are getting their balance right or not. But those figures are all backward-looking, and financial markets are forward-looking discounting mechanisms. It may therefore be worth keeping an eye on the yield curve on both sides of the Atlantic, using the relationship between the 2 and 10-year government bonds as a benchmark, and that means gilts here in the UK. Usually, 10-year government bonds will yield more than the 2-year paper, simply because more can go wrong in the additional 8-year period. Investors will demand a higher yield as compensation for the added risk. But as I sit here, 10-year treasuries in the US and 10-year gilts in the UK are yielding less than their 2-year equivalents. This may be due to markets pricing in interest rate cuts in response to a slowdown or a recession, and such an inverted yield curve, as it's known, can be a strong signal that a recession is coming. The past is no guarantee for the future, but note how headline stock indices have historically tended to top out when the yield curve has bottomed out at its most inverted, and that's probably because the recession, as predicted by the yield curve, kicked in and took corporate profits down with it. The second key trend also comes from the bond market, and it's the yield on 2-year government bonds in particular. This is because history suggests the yield on 2-year government paper will lead central bank monetary policy by some 6 months. History again, no guarantee for the future, but if this relationship holds firm, then the bond market could give a valuable steer as to whether interest rates are staying higher for longer or moving lower much quicker than expected. The third trend to watch is commodity prices, both in absolute terms and relative to share prices. The Bloomberg Commodity Index, which follows the spot price of 23 different products ranging from oil to gold, wheat to cotton, and hogs to cattle, is up around 10% in 2022, so it's doing much better than every major stock market and beating the bond market hands down. But the index is still down by 1/5 from its year high, as the Turkish broker deal gets grain moving out of Ukraine, oil prices sag as Europe mops up supplies of liquefied natural gas, and fears grow that a recession will hit demand for many raw materials in the coming year. If central banks succeed in reining in inflation, reasserting control and taking the world back to the low growth, low inflation, low interest rate Goldilocks environment that prevailed throughout the 2010s, well, commodity prices could again stumble. They may also do so if indeed we do get a deep recession. But if inflation, or maybe even stagflation, takes hold, well, real assets could come to the fore for 3 reasons. They could be stores of value. Central banks could cut rates or even start new QE programs, even if such money printing would only reaffirm they can't print oil or gold. And investment in new resources finds, while it's dwindling, thanks to pressure from politicians, investors, and the public alike, amid our environmental concerns that we just don't want any more holes in the Earth's crust. The fourth trend to watch is the financial and share price performance of semiconductor stocks. Silicon chips, as many of us will already know, are a good guide to global economic growth owing to their very ubiquity. They're everywhere, from smartphones to laptops, cars to industrial robots, and servers to smart meters. And global silicon chip sales are expected to top $600 billion this year to set a second consecutive all-time high. In addition, silicon chip stocks can be a good guide to investor risk appetite and global equity markets, at least judging by the past 2 or 3 decades. Again, history doesn't promise the future, but the 30 Stock Philadelphia Semiconductor Index, or SOX, topped out 6 to 9 months before the S&P 500 and FTSE All World in 2000 and 2007 to herald 2 thumping bear markets, and the SOX then bottomed out before these headline indices did in 2002 and 2009 to signal the start of a new bull market. Well, the SOX is down by a third from its December 2021 all-time peak, and profit warnings have started to pile up from its constituents, not least because inventories have begun to accumulate as end markets have softened just as producers were ramping up output in response to the shortages suffered in 2020 and 2021. Lower inventories, recovering profits, and a renewed increase in the SOX could all be good signs, although the opposite could also hold true. Finally, investors might like to keep an eye on transport stocks in 2023. Focusing on planes, trucks, trains, and ships is nothing new when it comes to assessing the economy and the financial markets, but as a strategy, it stands the test of time and could therefore again prove its worth in the next 12 months as central bankers, economists, and investors try to assess again whether inflation, stagflation, or deflation will prevail, not least because all three will require different policy responses and possibly different asset allocations for portfolios. Robert Ray's Dow theory argues that where the transports go, the industrials will surely follow. This is because in a strong economy, goods will need to be shipped and inventories and shelves replenished as product is sold to willing customers. The opposite holds in a weak economy, as inventories pile up, new orders are postponed or cancelled, and trains, trucks, ships all sit idle. Note how the Dow Jones Transportation Index peaked in November 2021 and the Dow Jones Industrials did so in January 2022, although the transports moved up from their autumn low just a week before the industrials began their year-end rally. Whether the rolling stock continues to roll in 2023 could be a key consideration. Thank you for watching. I hope that you and your families are all well in good spirit and in good spirits, and may 2023 be a happy and prosperous new year for you all.